What if I told you there was a way to make money while waiting to get shares of the stocks you want at a better cost basis? And this is the basis of options. And options are just contracts that allow you to buy and sell stocks, the underlying stocks, at prices that you want to buy them at or sell them at. Now, in this video, I want to go through what options are, how to use them, and two strategies that I think that long-term value investors would really appreciate to use in their own accounts to really bolster their gains. So with that, please like and subscribe, and let's get straight into this very, very valuable information. Now, there are two basic types of options that all other options strategies rely on and build off of. So the two basic types of options are call options and put options. Call options give you the right to buy 100 shares of the underlying stock at the strike price on or before the expiration date of the contract. Put options give you the right to sell 100 shares of the underlying stock at the strike price on or before the expiration date of the contract. So there are a lot of factors that go into each option contract. So you heard me say strike price and expiration date. These are two major ones. And for each option contract, there will be a strike price and expiration date. The strike price is the price at which you buy or sell the underlying shares based on whether you bought a call or a put. The expiration date is the time where the option contract becomes worthless after that date. So whatever happens has to happen before the expiration date of the contract. Whether you sell the contract, whether you exercise or get the shares or release the shares, that has to happen before the expiration date of the contract. Other factors that go into option contracts, such as implied volatility, the Greeks, the volume of the contracts. So I will go through some of the basics of the options while I give you these examples, so it becomes more clear as I speak what I'm talking about. And if you have any questions about anything I discussed in this video, please leave a comment or a question in the comment section below, and I will answer it as soon as I can. So just like you can buy a call and buy a put, you can also sell a call and sell a put. And so the dynamics of how they work change when you sell versus buy those contracts. Now, if you sell a call contract, you're obligated to sell 100 shares of the underlying company to the buyer of your contract based on what happens with the stock price. And then if you sell a put, you're obligated to buy 100 shares from the buyer of your contract, depending on what happens with the stock price. And this segues beautifully into what I think are the two best option strategies for long-term value investors, which are covered calls and cash secured puts. Go through an example of a covered call. Let's say you own 100 shares of Company Y, and Company Y is trading at $5 stock price. Now you want to make some money, so you sell a call at $6 strike price for 50 cents with a next month expiration. So the math on this works out to be 50 cents times 100, because each option contract represents 100 shares, times 1. You only sell one covered call. So that works out to $50 in total. So you essentially make $50 when you sell this covered call with a next month expiration. And now if the stock price does not exceed $6, which is the strike price, by the time this option expires, you get to keep your shares and the $50 that you made on selling this covered call. Now, if the stock price does go above $6 by the end of this call contract expiration, then you would be obligated to sell the 100 shares to the buyer of the contract. But between the current time and the expiration date of the call contract, you can always buy the call contract back to remove the position. Now, you may be wondering, why should I sell covered calls? Well, there are two main reasons. And one is you can generate income even from non-dividend paying stocks. So like big tech stocks, the majority of them don't really pay a dividend or a high dividend. You can bolster those gains with covered calls and generating those every time you sell those covered calls. And the other reason could be that you don't think the stock is going to appreciate in the short term, or at least until the option expiration time frame, and you can make some money on the stock while it's still relatively flat until the expiration of the contract. Now, let's move into my favorite strategy, which is the cash secured put. So let's go through an example of a cash secured put. Let's say you have $500 in cash in your account, and you want to make more than the interest that the account provides in income. Let's also assume there's a company Y, that you want to own long term. And this company is trading at $5 a share. So in this case, you could sell a put at $4 strike price for 50 cents with a next month expiration. And the math on this works out the exact same way that the covered call example worked out. So you have 50 cents times 100 to represent the 100 shares that the contract represents, times 1, because I'm only selling one put. And that equals $50 in income. If by the time of expiration, the stock price stays above $4, which is my strike price, then I do not buy the shares and I keep the $50 of income that I produced, which can be used for anything. But if the stock price drops below the strike price of $4, then 100 shares of company Y will be bought in my account using the $500 that I have. So you may be asking yourself the same thing as the covered call example. Why would I do a cash secured put? And there are several reasons, even more reasons than the covered call. One is you can get your shares, the 100 shares of a company that you already love, for a cheaper price, for a better cost basis. Second, you make money every time you sell a cash secured put. So you can make regular money by just selling these cash secured puts, and you can wait for the perfect time for the market to drop and actually trigger your cash secured put to buy the shares. But all along the way, if the stock is steady or going up slightly, you will be making money every time you sell a cash secured put. Third, it does not affect the interest that you're getting on the cash that's sitting in the account that is designated for the cash secured put, meaning that you are still gaining the interest from the account, wherever interest-bearing account it is held in, while you are making money on the option from the option premium for the cash secured put. So it's almost like a triple whammy of income. You can make money in the account like you would normally would. You make money from the option, and then if it does trigger, you get a better cost basis on your shares that you already want for the long term. So I feel like it's the best, simple, basic option strategy that all investors can use and make money from. Finally, probably the most interesting part of this is that you can do long-term options, more than a year. So if you have a truly long-term investment mindset for some of these investments that you want to do, let's say I want to hold Google for 10 years, then I could sell a cash secured put on Google that expires in a year or 2 years. And that is treated better tax-wise by the IRS than a short-term option like a week out expiration or a month expiration. I want to show you guys how I have used options to make money. So recently I've done some cash secured puts on Warrior Met Coal. So let me go through an example and show you what I actually did within the past 10 days to make money using cash secured puts. So here I have a screenshot of the actual trade that I did in Fidelity, and this is in a separate account, not my public account. So here you can see that I've did an opening transaction of selling a put, 3 puts actually, I sold 3 puts on Warrior Met Coal HCC, and the expiry is October 17th, 2025, and the strike price is $55. And it's a standard options contract, each contract representing 100 shares. So I received $550 for selling these 3 contracts a month apart. Can you imagine making that much money and just doing nothing? It's just selling these contracts, making sure you have the cash to cover the buy if it happens, but just selling it and making $550 for not even holding the stock. This is just to sell the option contracts. So I sold it on September 8th, not 7 days ago. And this is the option symbol. Option description is a put, Warrior Met Coal, expiry October 17th, 2025, strike price $55, each one representing 100 shares. So this is, if I sold 3 of these, that means 300 shares. I would buy 300 shares of this if the stock price went below the strike price. It's a cash type of accounting because I'm not using any margin here. I have enough money to cover this $300 share purchase. 3 contracts. Negative means you sold it. The price for each contract, option price for each contract, was $1.84. So that multiplied by 3 multiplied by 100 is the 5 minus any fees is the $549.98 that I received. The fees is $7 cents. Pretty low in fidelity. The amount I received and the settlement date was the next day. So if you look at this example, you can see how powerful options are. The crazy thing is I could do that every month if it doesn't trigger, and I still have a long-term thesis in Warrior Met Coal, which I do. At the time of expiration in October, I could roll these options to the next month, to November, and then make another $550 again. So it's really cool what you can do with these options. So here I've pulled up Meta's options chain, and the first thing you'll notice is that they are organized chronologically by expiration date. So here you can filter, this is in Fidelity, and you can filter by expiration date. Currently, I have October 17th listed, so it will pull up the entire options chain, all the strike prices for the October 17th expiration, and it even tells you it expires in 32 days. In addition, it will show you the dividends denoted by D and the earnings dates denoted by E here. And those are important to note because usually there'll be a lot of volatility in options during those times because buyers and sellers are trying to get in and out of the market during those times. So it might even be a great idea to avoid those times because you never know what a stock is going to do during an earnings call or a dividend, ex-dividend date. So the backbone of this options chain is the strike prices. So they're all organized by time to expiry and by strike prices. So if you look on October 17th, 2025's option chain, you'll see the strike prices down here. And if you go all the way down to around 776 or 770, for Meta, that's where the stock is trading at. So you can easily see that all the shaded calls and all the shaded puts in the money contracts. And everything that's not shaded is the out of the money contracts. Let's say I wanted to sell the 750 strike price Meta put. I would need $75,000 to be able to sell a cash secured put at this level. That is because it's 750 times 100 times one contract. And for doing that, for locking that up, I would make about $1,760 because the option price right now is between $1,760 and $1,785. So you would multiply this by 100 because each contract represents 100 shares. So it's a leveraged bet on the price action of a company. Also, there are various data points that each option contract has, and it's beyond the scope of this intro video, but in the future, if you like I can go through an in-depth options tutorial explaining all the things like the Greeks, theta, delta, implied volatility, time value, intrinsic value change. I can explain all of these things in a more in-depth video later on if you want. But please leave the comments down below and let me know if that would be useful to you. And that's it, guys. Options seems like a very complex topic, and sometimes it can be, but with the basics in tow, you can really make some sizable gains and consistent gains with options, with the basics of options. And I hope that you got immense value from this video. If you did, please like and subscribe, and I'll see you guys in the next one.